Hi everyone, and thank you for joining me in this installment of my Q&A with Wall Street series. In today's episode, I'll be covering Disney and its Q&A with Wall Street on February 8th. So let's get right into it. The first question coming from Bank of America asking the analyst asking about the 3 billion in cost cuts that Disney announced. What's it going to mean? Is that fewer titles, and what about margins? And CEO Bob Iger jumping in to answer, saying we're going to be fairly aggressive at better curation when it comes to general entertainment, because when you think about it, general entertainment is undifferentiated as opposed to our core franchises and our brands, which because of the differentiation and their quality have delivered higher returns for us over the years. So it looks like Disney's going to focus more on their proprietary brands, their proprietary content that cannot be duplicated. Think of things like Marvel, right? Those characters are exclusive to Disney. Nobody else can copy those characters. And so spending money on creating content, developing those storylines can deliver better return on investment because viewers can only get something like that from Disney. So that's where it looks like Disney is, the direction that Disney is heading towards with these comments here. The CEO goes on to say, we have an ability to balance how we take our product to market with legacy platforms, whether it's movie theaters or multi channel TV, with, of course, the streaming segment also. So that's an interesting competitive advantage. Disney compared to Netflix, that Disney has these legacy cable TV channels and the movie theaters as an outlet for where it can launch its movies before they end up or during while they end up in their streaming segment. For example, its newest movie, its newest hit movie, Avatar: The Way of the Water, has already delivered over $2.1 billion in box office revenue in the movie theaters. Now, that is already revenue and cash flow and profits coming to the company in excess of what the movie cost the company. There was rumors out there that it cost them about they needed to exceed 2 billion to break even. So they've already went across breaking even and profitability. Now all of the benefits that come from that movie over time is just going to be profits and free cash flow. That movie is going to hit the streaming segment. When it does, it's likely to bring in new subscribers that would like to see the movie, and also it's likely to retain existing subscribers who will be happy that, oh, we have this new hit movie coming onto our platform. Disney could also show that movie on its legacy cable channels, right? It can show the movie on ABC, it can show the movie on FX or one of its other channels on cable, and in that way generate more revenue. And those are generally ad supported, so generate ad revenue from those viewers watching the content there. So these are different areas where the company can launch its content across and generate incremental revenue, where Netflix is just exclusive, whatever they make on the Netflix platform, and that's it. No merchandise, no movie theaters, no cable channel revenue. So it makes it, if Disney can manage this effectively, it could be an advantage going forward. The next question comes from Benjamin Swinburne from Morgan Stanley, asking about more content is being viewed streaming versus linear, obviously declining, and the theme park business had really strong margins this quarter. So, Morgan Stanley analyst wants to know more about these two areas. And first, the CEO jumping in, saying, speaking about the streaming. So, because you're in most cases you're signing up to a 1 month subscription, you can sign up for one program, pay a relatively small fee, and then basically end up unsubscribing. So these are less sticky customers than those that sign up to a cable subscription or a cable bundle, because it's more difficult to cancel a cable subscription most often those come with a 1 or 2 year contract, so customers can't just sign up and cancel and switch as easily as they can with streaming. So some of the challenges related to the streaming business, which I believe is the future, is growing and not delivering basically the same kind of profitability that the linear business was used to over the decades. And that's been a growing risk for Disney stock, and why the stock has been relatively flat if you go back all the way to 2016, when signs first began to emerge that customers were canceling cable and satellite subscriptions en masse and switching over to streaming instead. And it was, the die was cast that Disney was going to need to switch over to that platform as well, and it was going to disrupt its legacy business where it delivered consistent and healthy profitability. So now they're going to need to rebalance a bit, because those linear channels and movie theaters still can provide us with significant monetization capability. They enable us to amortize the cost over multiple platforms and create some marketing clout. When you think about it, for example, Abbott Elementary airs on ABC and then it goes to Hulu. And here's the key point: the demographic difference in age is tremendous. The age cohort on ABC is roughly 60 years old, and then on Hulu it's roughly 30 years old. So it's a different customer group. The older demographic still likes the cable channels, the cable bundle, and the younger demographic likes the streaming. And so for Disney right now, they're taking advantage of both while they can, but as this older demographic ages and they start to lose more customers, then more will be reliant on the streaming segment. But for now, they're getting the benefit of both worlds. And I will end with this comment the CFO, Christine McCartney, makes on the park segment. We had mentioned that the recovery from the pandemic and international parks was lagging domestic. Which had been a strain on the company, right? The domestic parks had been doing incredibly well. The international parks had not yet. But in this quarter, we had very strong performance, especially from Disneyland Paris. We had the opening of Avengers Campus over there in July, and that's been incredibly popular, driving attendance. And also, we have a new hotel that was redone into the Art of Marvel. So the international theme parks are coming alive now that the COVID pandemic has begun to ease just a little bit more, and travel restrictions have begun to ease a little bit more, notably the economic reopening in China. And so these are going to be further tailwinds for a segment for Disney that's been absolutely thriving. All right, so that's all I've got for this video. As always, I absolutely appreciate your viewership. Thank you for coming by, and I hope to see you again soon. I want to thank the Motley Fool for sponsoring this video. Visit fool.com/parkev for the 10 best stocks to buy now.